The Subcommittee on Capital Markets will come to order. And without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled, Empowering Entrepreneurs, Removing Barriers to Capital Access for Small Businesses. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I recognize myself for opening remarks. 11 years ago, the Jumpstart Our Business Startups Act, or JOBS Act of 2012, was enacted into law by a divided Congress with the intention of increasing access to capital for small businesses and entrepreneurs in the United States. The purpose of the JOBS Act was to provide greater opportunities for small business owners and entrepreneurs to grow their companies and create jobs in their communities. Despite the successes of the JOBS Act, there are still significant regulatory barriers that impede the growth of small business and hinder the competitiveness of job growth of the United States. Small businesses, which make up 99% of all enterprises and employ almost half of the U.S. workforce, are disproportionately affected by these barriers. The lack of access to capital makes it challenging for small business owners to grow and expand their companies, which can limit job creation and, of course, economic growth. For this reason, I am thrilled to convene this hearing today and to discuss policy reforms that will reduce the obstacles and improve access to capital for small and private businesses and entrepreneurs across the country, not just in the financial centers on our nation's coasts, but in every state. The decline in small business loan approval rates from 81% before the COVID-19 pandemic to 68% in 2021 underscores the importance of maintaining and enhancing our private markets as a viable option for small business capital needs. If we limit access to capital in our private markets, as SEC Chair Gensler intends to do, where will small businesses turn for funding, considering the decrease in particular in loan approval rates? The need for access to capital is critical, and small businesses must have options available to them to secure the funding they need to grow and create jobs. Republicans in this committee believe that entrepreneurs and founders should raise money with as little friction as possible. As a result, Congress and regulators must adopt common sense, forward-thinking policies that reduce barriers and increase access to capital, raising opportunities for American entrepreneurs. The proposed legislation that we are discussing today will lead to increased competitiveness and more opportunities for companies on Main Street to thrive. Healthy public and private markets can coexist, and we should work together to pursue policies that make both markets attractive places to raise capital and spur economic growth. As a chairman of this subcommittee, I am eager to tackle these regulatory barriers that prevent small businesses and entrepreneurs from accessing capital. Today's proposals will enable all entrepreneurs, including those who have been overlooked and underserved, to create jobs and grow their businesses, regardless of their background or location. Our goal is to ensure that small business owners and entrepreneurs have the resources they need to succeed and create jobs in their communities. In conclusion, the JOBS Act of 2012 was a step in the right direction, but there is still much work to be done to improve access to capital for small businesses and entrepreneurs. The regulatory barriers that exist must be addressed, and policy reforms must be implemented to reduce these obstacles and enhance access to capital. This will enable small businesses to grow and create jobs, contributing to the overall economic growth and competitiveness of the United States. I am committed to working with my colleagues in this subcommittee to achieve these goals and to make the American dream a reality for entrepreneurs. The chair now recognizes Mr. Sherman, the ranking member of the Capital Markets Subcommittee, for 5 minutes for an opening statement.
Glad we're having this hearing, the second of today. A little jealous of Ms. Wagner for she is in a situation where she's allowed to hold 2 hearings in one day. Sometimes you're not allowed to hold 2 hearings in the same month under some circumstances. We're talking about removing barriers to private placements and small business. Keep in mind that sometimes barriers are good, sometimes they're not. We're always told the barrier prevented you from investing in Apple. Maybe it prevented you from investing in pear, banana, or kumquat. When a barrier successfully prevents an investor from investing in a bad or fraudulent investment, or an investment where there's not enough information to evaluate it, that is not just good for that one investor, it's good for our overall capital markets. The willingness of Americans to invest is dependent upon the protections they enjoy. And our present system is not working all that poorly. When the private placement market raised $4.45 trillion from July 1 of 2021 to June 30th, 2022. And it did so without the biggest frauds and disasters that we're aware of coming to mind. I remember when the biggest failures were WorldCom and Enron. Today, the biggest failures or most famous ones that come to mind are FTX and Luckin Coffee, not subject to U.S. regulation. If you send your money to China, you send your money to the Bahamas, you cannot then complain that Gary Gensler did not protect you. We should be drafting statutes that help genuinely small business. When people in my district think of small business, they think of Casa Vega on Ventura Boulevard, not some company with a $2 billion capitalization. That doesn't mean we shouldn't draft statutes that help medium-sized businesses, but we shouldn't paint a picture of a pizzeria and then draft a bill for a $2 billion enterprise. We need the right picture when we're drafting the bill. As I think all of you know, I'm old. Even before I came to Congress, I was in the business world as a CPA and attorney, and back then, banks lent money to small businesses even when there was a chance of failure and without taking a note on the owner's home. They would make a prime plus 3, a prime plus 4, a prime plus 5 loan, and that was a fair loan because that loan had a 4 or 5% chance of a default. The business might have a 4 or 5% chance of failing, and if that were to happen, the bank might recoup only half the money that it lent. Today's bank examiners won't let you do that. And so banks, the traditional way a small business gets financed, isn't available. I made that point in this room, but not at our hearing, but the financial institutions hearing this morning. And so what we need is for our banks to be able to have a portion of their loans, a portfolio, with some risk of default and some risk of loss. A second source of capital is small business investment companies. Last year, along with Mr. Huizinga, I introduced a bill that would help those companies get capital, and they then put their capital into small business. Due to a quirk, investment index mutual funds can't really invest in small business business development companies because of the way the SEC defines the expenses of the mutual fund that's making the investment. BDCs are a vital source of capital to the genuinely small business. We're going to reintroduce this legislation. We're looking for co-sponsors who want to be originals. We'll probably reintroduce it tomorrow. It's the Access to Small Business Investor Capital Act. I'm told that between the 2 hearings today and then one we'll do in early March, that we'll be considering 30 bills, including discussion drafts. As far as I know, the Access to Small Business Investor Capital Act will be the only one that has an official Democratic chief author. although I'm thrilled to have Mr. Huizinga working with me on the bill, and I'm hoping that we won't just be talking about 30 bills, but even more and more with Democratic chief authors. So I look forward to working with you both in the morning and the afternoon to have a balanced approach to making more rational our private offerings, not with the goal of reducing or increasing regulation, but making it more rational. I yield back.
Thank the ranking member. We are certainly have offered prior to the notification or after the notification of this hearing, bills to be put forward for consideration. I'm sure there'll be a lot of Democrat co-leads on many of our bills, so we look forward to working together. And I promise I will make you work morning and afternoon, rarely nights. So here we are. I want to welcome our witnesses. First, we're going to hear from Mr. Mac Conwell. Mr. Conwell is the founder and managing partner of Rare Breed Ventures, an emerging VC fund located in Baltimore, Maryland. Mr. Conwell is a former software engineer and two-time founder. When he started his first fund, he did not have a network of limited partners, so he raised money on Twitter under the Rule 506C reforms implemented by the Jobs Act of 2012. Welcome. Next, we have Mr. Doug Elenoff, a regular here, I believe, is a partner with the Elenoff, Grossman, and Scholl LLP. His practice focuses mostly on business transactions, mergers and acquisitions, and corporate financings. During his career, he has represented numerous broker-dealers, venture capital investor groups, and many corporations involved in the capital formation process. Welcome. Next, we have Ms. Deborah Gladney. She's co-founder of WorkTorch. Ms. Gladney is an entrepreneur with more than a decade of experience designing communication strategies and programs. Prior to co-founding WorkTech, an education tech company in Wichita, Kansas, she managed stakeholder engagement, media relations, reputation management, and strategic positioning for corporations and nonprofit organizations. Welcome. Ms. Darcy Howe. She now hails from Kansas City, Missouri, but she used to be a constituent of mine in Kirkwood, Missouri. She's the founder and managing director of KC Rise Fund. Ms. Howe has been an angel investor for 20 years. She is a founding member of a Merrill Lynch private banking and investment group of Merrill Lynch in Kansas City, which grew from 30 advisors to 350 with $240 billion in assets under management and over $1 billion in revenue before her retirement in 2015. She started KC Rise Fund after recognizing the need for local economic growth in middle-income areas in the greater Kansas City region. Welcome. Ms. Alexandra Thornton. She is the Senior Director of Tax Policy with the Center for American Progress. Prior to joining the Center for American Progress, she worked as the Executive Vice President for Policy, Planning, and Business Affairs at the Jane Goodall Institute and was a tax policy advisor to a U.S. Senator who served on the Senate Finance Committee, where she provided counsel on trade, banking, and securities issues. I want to thank all of you for taking the time to be here. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. We're going to have a tight gavel here today, so pay attention to the clock, please. Without objection, each of your written statements will be made part of the record. Mr. Conwell, you are now recognized for 5 minutes for your oral testimony.
Thank you. Madam Chair Wagner, Ranking Member Sherman, thank you for the opportunity to testify.
If you could speak up just a little bit, Mr. Conwell.
My apologies.
I'm not sure if your mic's on. Is it on?
I believe it's on.
Okay, there, we can hear you now.
Madam Chair Wagner, Ranking Member Sherman, thank you for the opportunity to testify today on the importance of creating better access to capital for both entrepreneurs and those who fund their amazing companies. My name is McKeever Edward Conwell II, and I am the founder and managing partner of Rare Breed Ventures, or Rare Breed, which I am representing today. Rare Breed is a venture capital or VC firm that invests in and supports innovative startups in the earliest stages. I want to first say that I am here to address the much-needed improving capital allocation for newcomers, or ICANN Act, due to my personal experience in raising a fund and my expertise, but I am in full support of all 7 bills being addressed today. In 2020, I launched Rare Breed Ventures as a response to the lack of access to capital for founders of color and founders outside of major investment hubs, as well as a response to the lack of cultural competency from many VCs when it came to investing in founders who didn't look like them or didn't come from similar backgrounds. These 2 issues came to me in the form of Shauna Step-Jones, a Black single mother from Baltimore who was creating a dryer for wigs. I immediately got what she was creating, but other investors didn't. So after 3 years of getting no's from folks who didn't look like her, she decided the only way for her to get access to capital was to become a surrogate mother, even knowing that Black women are 3 times more likely to die from pregnancy-related causes. This is why I started Rare Breed Ventures, but I didn't have a network of wealthy folks to raise the fund from. It forced me to get creative and use 2 regulations to help. First was Rule 506C of the Regulation D, which allows for public solicitation of a fund's offering, but requires that every investor in that fund be an accredited investor. The second was an amendment to Section 3C1 of the Investment Company Act of 1940, which allows for a fund of $10 million or less to have up to 250 investors instead of 100. The first regulation allowed me to use social media, Twitter mainly, to meet with many potential investors. Thanks to this, I was able to have 1,128 meetings in my first 90 days and more than 4,000 meetings in total. The second regulation allowed me to offer investors to invest as little as $10,000 compared to $100,000 I would have had to ask them to before the amendment. This led to me having 194 investors in Rare Breed. Of these investors, 83.5% invested $50,000 or less. Many of these investors are people of color or first-time investors in a fund because they hadn't had access to make such an investment or couldn't risk the high minimum threshold for funds. This means that before they were limited to investing in companies either directly, where there is a much higher risk of them losing all of their money, or investing in stocks of publicly traded companies, which the average venture fund has historically outperformed according to the Harvard Business Review. But unfortunately, without the ICANN Act, almost all of these small dollar investors who make up 83% of our investors will not be able to invest in Rare Breed Ventures Fund 2. That is 162 out of 194 investors, since our new minimum will have to be at 250,000 or more. The current rules limit the amount of capital and sources of capital for small and new investment funds, leading to less capital to help drive innovation, economic growth, and job creation, especially when we're talking about companies started by founders of color, because we know that in particular, Black-led funds are 4 times more likely to invest in Black-led companies. Also keeping in mind that almost all of the Black-led venture funds in America would fit under the new rules of the ICANN Act because most of us have funds that are less than $150 million. With the ICANN Act, such limiting factors would be greatly reduced, allowing more accredited investors to have opportunities to participate in the asset class. With lower minimums, investors can potentially invest smaller amounts of money into more VC funds to spread out their risk and better diversify their investments. Today, many funds have to turn away investors because of these current limits. This results in millions of dollars in potential funding for future innovation and job creation, while also excluding investors from being able to truly diversify their own investments and limiting their ability to wealth creation. Even more so, those who do have enough wealth to continue to participate in the venture asset class almost exclusively are from a non-diverse population. This only serves to further widen the racial and gender wealth gap here in America and puts limits on the types of innovations we see in this country. In conclusion, I am excited to see Congress working through issues that impact access to capital and drive innovation. As someone who has spent my entire career in venture capital as an advocate for access to capital and reducing barriers, I look forward to supporting and assisting this committee in any way possible. Thank you for the opportunity to testify today, and I look forward to your questions.
And we thank you. Mr. Elenoff, you are now recognized for 5 minutes to give your oral testimony.
Thank you, Mac. He's the veteran here. He understands how to do this. Ranking members Sherman and Waters, and members of the Capital Markets Subcommittee. It's a pleasure to be a part of this important hearing. I was last here in front of this subcommittee September 11th, 2019, for the hearing examining private market exemptions as a barrier to IPOs and retail investment. There have been significant developments in the capital markets since, and we are now back to an environment where entrepreneurs need further assistance of Congress. I trust that you will seriously consider the proposed bills all of which I support. My name is Doug Elenoff. I'm a partner in the New York-based law firm of Elenoff, Grossman & Scholl. I'm a corporate and securities lawyer and have been practicing for over 35 years. My law firm has been in business for more than 30 years, and there are nearly 130 lawyers, and we are regularly one of the top 10 IPO law firms in the country, and we do an equal number of other types of financings. We are market leaders in several alternative finance programs, including crowdfunding, SPACs, PIPEs, and registered directs. I've spent nearly 10 years after the passage of the Jobs Act working with the leadership of the crowdfunding movement, traveling extensively domestically and abroad, including dozens of trips to DC, to provide our views on the proposed and final regulation, crowdfunding, and various Jobs Act rules and regulations. I am legal advisor to the Association of Online Investment Platforms, the leading voice in DC for the industry. I'm also a co-founder of 2 legal technology companies catering to the broader crowdfunding industries, one called LawCloud and the other called Guard. My comments are those of my own and not my firm, nor my clients or the associations to which I am affiliated with. Given today's volatile market conditions where capital is scarce for entrepreneurs, not unlike the period right before an overwhelmingly bipartisan congressionally enacted Jobs Act, the timeliness of today's hearing is more important than it's been in the last decade. According to the data published by Crowdfund Capital Advisors, from the inception of crowdfunding in 2015 to 2019, my last testimony here, there was $193 million raised in the aggregate. Since 2019 until today, $1.4 billion has been raised. That's a 7-fold increase, which clearly demonstrates the commercial acceptance and viability of what Congress collectively put into motion in 2012 with the Jobs Act. There have been over 4,300 funded transactions, 3,500 just since 2019. We have empowered a nationwide footprint of entrepreneurs to access capital to fund their American dreams and create jobs, several of whom are with us, and it's exciting to meet them and see their vision come into reality, quite frankly. We've created 225,000 jobs. Although the studies are limited, the data indicates that of these funded transactions, 55% of them have at least one woman or minority founder, have an 81% success rate, and represent nearly 48% of all capital raised. We can all be very pleased with the results of crowdfunding, which would not have been implemented without the support of all constituents represented here. Regulators were decidedly uncomfortable with the idea of crowdfunding, and many of their stated concerns did not materialize. Had we not proceeded and acted together, our economy wouldn't have benefited, and more importantly, these entrepreneurs would not have been funded and been able to hire employees. It's a wonderful example of Congress taking action that has had a very positive real-world impact. On a personal note, since my last testimony, my fellow panelist Renee Jones left her professorship at Boston College Law School to be appointed director of the Division of Corporation Finance of the Securities and Exchange Commission, and Mike Pichik finished his time as head of the Department of Financial Regulation of the state of Vermont to be elected as the state's treasurer. So as you might suspect, I am a little disappointed that my status remains unchanged, but I remain hopeful that my testimony here today may have a similar impact on my professional resume as it has for my esteemed colleagues. I look forward to sharing my views on many of the proposals that will be discussed at today's hearing, and thank Chairman McHenry for hosting this important hearing today. Thank you.
And we thank you. Ms. Gladney, you are now recognized for 5 minutes to give your oral testimony.
Chairman Wagner, Ranking Member Sherman, and the members of the subcommittee, thank you for the opportunity to appear here today. My name is Deborah Gladney, and I'm the CEO and co-founder of WorkTorch. We're a career platform for service workers based in the heartland of Wichita, Kansas. I'm honored to be here today with my sister and co-founder sitting right behind me, Angela Mawezi-Hall, and be present for such a critical agenda that impacts entrepreneurs like us from across the country. When we started our company at the peak of the pandemic, we had no idea our company would take us to the places we've been, help the people we have helped, or allow us to see things we have seen. Things such as the extreme disparities in access to resources and capital amongst entrepreneurs. Last year, startups with all women founding teams like ours received just 1.9% of all venture dollars. And for Black founders, we received just a mere 1%. As if the odds aren't stacked up against us enough, 75% of all venture capital investments go to just 3 metro areas. And I can promise you, Wichita, Kansas isn't one of them. According to the data, my sister and I, as Black women founders in Kansas, should not be here in front of you today. What made the difference, you ask? We had our first example of hard work from our parents. They came to this country from Uganda and worked hard to obtain their doctorate degrees, all while raising their 5 children with no support or generational infrastructure built in this country. They were our first example of what it means to be an entrepreneur, to build something out of nothing, to be scrappy and resilient, even if you're told no 100 times a day, to take risks, even if it means leaving what feels comfortable for the chance at building something big. Even if it means me walking away from a comfortable salary while 8 months pregnant to build WorkTorch. Or even if it means my sister leaving an esteemed university in beautiful Los Angeles to live in my basement with her husband as we built our company. We did it because we knew building WorkTorch not only had the power to change our lives, but the lives of service workers and their families. Every single day, our company helps people find fulfillment in life while being rewarded for what they do. But without our parents' example, I don't think my sister and I would have made it this far. When we started WorkTorch, we had no connections or family or friends we could lean on for capital. We cold pitched 379 investors, and we received 379 no's. We had to pull money from our own 401ks to build our product. But with our little money, we created a platform that garnered over 1,000 users in the first few weeks without receiving a dollar from anyone. The scrappiness our parents taught us is what got us to the point of eventually becoming the first Black women in Kansas to raise over $1 million in venture funding. But we also had to come to the table with twice as much to often receive twice as less. It's also hard for us to be proud of the fact that in 2023, we are still seeing a lot of firsts for minority and rural entrepreneurs. Access to capital is literally stunting the ability for many businesses like ours to grow. And this is why today's proposed bills are so important. Wouldn't it be great if more people who looked like me could invest in more people who look like me? The simple fact of the matter is that who gets funded depends a great deal on who is doing the investing. As a nation, we know the benefits of encouraging entrepreneurship across backgrounds. We create jobs, we spark innovation, and allow America to maintain its position as the most competitive nation on the planet. So it's in our nation's best interest to foster more firsts like my sister and I, and create more seconds and thirds and fourths and beyond to where we won't even have to count anymore. It's my hope you'll be on the right side of entrepreneurial history today, and I look forward to your questions.
We thank you, Ms. Gladney, and so glad that you and your sister are here with us today. Congratulations. Now, Ms. Howe, you are recognized for 5 minutes to give your oral testimony.
I've heard this story a lot, and I'm still verklempt. Chair Wagner, Ranking Member Sherman, and distinguished members of the Subcommittee on Capital Markets. I'm Darcy Howe from the America's Heartland, Kansas City. Congressman Cleaver's territory, go Chiefs. Yeah. And I've seen barriers to capital access firsthand. As Deborah said, 75% of the venture capital to invest in technology startups come from 3 states, California, New York, and Massachusetts. They're bold, innovative ideas to solve business and societal challenges in every county in this country. And they've gone unfunded, and that was a contributor to the slow economic growth of my region in Kansas City. In 2015, KC business leaders realized that after the 2008 downturn, we did not bounce back as well as peer cities like Indianapolis and Nashville. Many in our community set out to bring solutions to the region, and my volunteer assignment was to understand what was happening in entrepreneurship. What I learned was that 70% of all net new jobs in the KC area come from someone who's starting a business, 70%. But those starting high-growth technology businesses were leaving the area because capital was on the coast. Further, I learned that most rural entrepreneurs, people of color, and women were not getting funded at all. So what did we do to bring inclusive capital to Kansas City? With friends, we started an angel investing group to invest in women-led businesses called Women's Capital Connection. Then I decided to retire from a successful 32-year career as a wealth manager and devote these past 6 years to raising capital and funding amazing innovators like Deborah and Angela in our region through the Casey Rise Fund. Illustrating success that when capital and innovators are connected, in 6 years, the 46 portfolio companies in our fund have created more than 1,000 jobs at an average wage of $98,000. And by the way, the average wage in Kansas City is $45,000, which is our starting wages. If our 46 companies were one company, we would now be the 40th largest company in our region, and virtually none of these 1,000 jobs even existed 7 years ago. In the past 3 years, 62% of our investments included at least one founder from at least one underrepresented demographic. 51% of the employees, people think about founders, but think about the employees' generational wealth that they're building and skills. 51% of the employees of our portfolio companies came from an underrepresented demographic. These inclusive statistics far exceed coastal venture-backed businesses. You've now met one of our amazing founders, Deborah Gladney, and can see why investing in WorkTorch was not a hard decision for my partners, Ed Frent, Liam, Riley, and myself. Casey Rise Fund invested $400,000 and made introductions to venture capital firms in other parts of the country, which led to 4 more firms investing for a total of $1.1 million. And I'll add parenthetically, Steve Case from here in DC was one of them. As the eyes and ears of our region for VCs around the US, our support was validating to other venture firms in our network, which made her raise successful. So tell me again why we need these 7 bills if all of this is working so great. Well, I can speak to the DEAL Act, SEEDS, HALOs, and ICANN. ICANN is the bill which would unlock the most access to capital for small venture funds like Casey Rise. Our first fund was $19 million, and it took me 2 years to raise. Limited to 99 accredited investors, I had to find people willing and who had the resources to invest on average of $200,000. For Fund 2, we wanted to increase capital in the region, so we set out to raise $40 million, and now our investors had to have $400,000 on average. Not every small venture fund manager has a network like I've built over 30 years, and even I had trouble raising for startups, a type of investment that most people in the Midwest had never done before. Please don't confuse us with a big-time private equity bunch with mountains of money. There are hundreds of small funds like ours springing up in smaller markets, and we would all benefit from raising the limit on our total number of investors. It would accomplish 3 things. I realize I'm getting close on time. First, it would allow more folks to participate. Funds could take smaller investors, really democratizing capital and being more inclusive. Secondly, being able to take more investors, we can more easily build a larger fund. And third, more people would get off the sidelines like me to do it. Funds are expensive. We've got back office, we've got rent, we've got audits. Making a fund a little bit larger would make it possible to have a small team to help entrepreneurs. So more inclusive capital is the lifeblood of new jobs in all counties over this country. And we're seeing already in our region in Kansas City that generational prosperity is broadening due to our focus and increased capital.
Thank you, Ms. Howe, very, very much. Next, Ms. Thornton. You're now recognized for 5 minutes for your oral testimony.
Chairman Wagner, Ranking Member Sherman, and esteemed members of the subcommittee, thank you for the opportunity to appear before you today to discuss capital access for entrepreneurs and small businesses. My name is Alexandra Thornton. I'm a senior director focusing on financial regulation and tax policy at the Center for American Progress, an independent, nonpartisan policy institute dedicated to improving the lives of all Americans. Today, more businesses have raised more money from borrowing, selling equity, and selling debt securities than ever before. In fact, banking regulators are worried about a collapse, securities regulators are worried about the proliferation of frauds, and investors are worried that many private company valuations are unjustifiable and unsustainable. In addition to seeking a loan from a bank, small businesses today can turn to the capital markets. After decades of deregulation by Congress and the SEC, a company can raise an unlimited amount of money from an unlimited number of sophisticated investors without making any meaningful disclosures about its financials, governance, operations, or risks. Moreover, unlike banks and their employees, private equity and venture capital firms that raise capital and invest in businesses are generally not expected to follow regulator-mandated standardized documentation requirements and regulatory oversight of their capital allocation decision-making or the fees that they charge. Venture capital and private equity funds are larger than at any time in history. Small businesses ought to have no problem obtaining capital in this environment. The problem is not that the rules prevent small businesses from obtaining capital. It's that the rules today allow companies with billion-dollar valuations, billions in revenues, and thousands of investors to continue raising private capital without providing basic information to investors, regulators, or the public, and private funds to raise billions of dollars from underlying investors without basic information about their procedures around capital allocation and portfolio management or the fees they charge. SEC Chair Gensler said very recently that there may be as much as $250 billion in fees in private funds each year, and much of that money isn't going to portfolio companies, including small businesses. There's also no regulatory requirement that these billion-dollar companies and funds provide investors with basic audits to ensure that financial information is accurate and reliable. When Congress established the federal securities laws in the wake of the Great Crash of 1929, it concluded that without basic information about a company, capital will be misallocated and wasted. So it established the fundamental bargain that companies that want to raise capital from the public must first provide basic information to investors and the public, and including the company's financials, governance, operations, and risks. Today, these disclosures, along with robust audits, improve price discovery, make markets more fair, more orderly, and more efficient, and protect investors from abuses. It goes without saying that even the most sophisticated investors can't exercise their superior knowledge and expertise if they don't have reliable information about a company's financials, operations, and risks. For decades after the securities laws were first adopted, offerings to even a single person or to a small number of employees were deemed to be public offerings in need of registration. But beginning in 1982, with the promulgation of Regulation D, Congress and the SEC began expanding the number of exemptions from the public disclosure framework, often with the stated intention of providing more access to capital for small businesses, just as many of the bills before the subcommittee today are saying. But in reality, those exemptions, along with a few other provisions in the law, have enabled virtually any company of any size to obtain capital from the public without complying with the public disclosure framework. A growing number of companies are choosing to remain private, and the majority of capital today is exempt from the public disclosure framework. Today, more than 650 U.S. private companies worth more than $1 billion each in the private markets, and they too rely on these exemptions. They compete with similar publicly traded companies and sell products and services to a broad swath of the American public without making meaningful disclosures. They can pose huge risks to their investors, who include the teachers, firefighters, municipal workers, students, professors, and many others, who have a significant amount of their hard-earned college and retirement savings invested in the private markets. Failure of any of these unicorns could have catastrophic consequences for these investors. Expanding exemptions from public offerings will only make the wealthiest private investors richer, and it certainly won't help truly small businesses in underserved communities. There are many steps that Congress and the SEC can take to rebalance the public and private markets and make more room for capital for small businesses. I look forward to discussing those with you, and thank you again for inviting me to testify today.
Thank you, Ms. Thornton, very much. Thanks to all of our witnesses for your testimony today. I will now move into the portion of questioning by our capital markets members. I recognize myself for 5 minutes. Mr. Elenoff, as I'm sure you are aware, Democrat SEC Commissioner Crenshaw gave a very concerning speech last week in which she cited growth in our private markets as a reason to increase disclosure and impose other regulatory obligations on private companies. In our view, her comments demonstrate how Democrats would rather force companies to go public than reduce barriers to capital formation for all companies. Mr. Elenoff, if the Democrat-led SEC moves forward with and eventually finalizes proposals that increase burdens on private companies, as it is as it likely will in its forthcoming proposed rulemaking to revise Regulation D and Form D. Can you explain how that would harm the millions of businesses that remain private? And what I'm really trying to get to is, would it make it harder for them to raise capital, create jobs, reach potential, or would these policies considered today, on the other hand, make it easier for small businesses to grow?
It's a troubling, coordinated narrative that we're hearing. I think there's no doubt that increasing disclosure and pre-filing submission requirements on those issuers would be very problematic for a marketplace that's been around since 1982 and has operated efficiently, successfully by the numbers that we heard from Representative Sherman earlier, a $4 trillion marketplace. I don't know why we'd even consider going about regulating it in a similar manner to what we do with our public company universe. These companies chose tactically to not go to the public markets because of the overregulation within the public market sphere, and particularly over the last year. So I think you would end up seeing a reduction in the capital raising process. I think the securities offering supply chain, yes, I'll take credit for that term, I think would become bogged down, and I think it's ill-advised and unwise, and I would stay clear of it. And the thought process that somehow you can, as a securities lawyer, it would be a boon for me. So when a securities lawyer is telling you not to do something, even though it would benefit me personally, I think you should take that under advisement. I think to force large companies that choose to remain private, which is the same conversation we had in 2019. So the question is, how do you incent them to become public? And the thought process to burden private companies more is the incentive to get them to become public seems misguided to me and quite troubling.
Thank you very much. Ms. Howe, as an angel investor, you have helped countless early-stage companies in my home state of Missouri and beyond raise the capital that they need to grow. In doing so, you've supported founders and their communities. You've also witnessed some of the barriers that exist which prevent startups from reaching their potential. From your experience, could you provide examples showing how the policies considered today would benefit the early-stage companies that you invest in?
First, maybe going back to Ms. Crenshaw's report and maybe addressing Ms. Thornton. I hear a lot of unicorn and $1 billion. These are companies that we're investing in them at $5 to $10 million or $15 million, and they'll probably sell somewhere between $50 million and $400 million as a bolt-on to some other business. So the kind of businesses that we invest in tend to start smaller and they exit smaller as well. And so it's a different mindset than maybe some of the understandable concerns about regulating much larger companies. I'd also say that we turned down investors. We had investors who were much more diverse, frankly, and both in age and gender and ethnicity, because they couldn't afford to invest in a fund that had an average need of $400,000 investors. So by broadening it out, I think we would have much more inclusive capital. And I'd also say that one of the things that is troubling to me, and I agree with the protections I was in the financial services business for 32 years, we need protections, but a fund format like we have, and like all of these small funds that are being formed, by the way, and we have audits as well, but a fund format is a more diversifying, de-risking way for people to invest and to participate in their neighbors, their kids, the people they want to invest in who are in their own local community.
Thank you very much, Ms. Howell. I've got a fantastic question for you, Ms. Gladney. I'm going to submit it for the record since my time has expired. I now recognize the ranking member, Mr. Sherman, for 5 minutes.
Some have said that sometimes the system doesn't fund somebody's business idea. I would say that's actually a good thing. Most ideas shouldn't be funded. I have a dozen ideas every day, most of them bad. And if you take a look at the bills submitted here in Congress, most of them shouldn't be passed. The chairwoman says that there are millions of companies that are private that should stay private. Couldn't agree more. But there are a few dozen, just a few dozen, that we should encourage to become public, that are large enough to easily deal with the costs of being a public company. If these companies become public, then we get more information about them, both in terms of trying to look at our society, but also for investors. They can afford to do it, and then the retail investor can get the liquidity of a publicly traded company, the information, the analysis of a publicly traded company. We're here trying to decide whether to, in some cases, liberalize or in some cases tighten the rules for what it is to be a private placement or a non-public offering. We dealt with one of those this morning, changing the definition of accredited investor. Boy, a whole hearing focused on that. Doug, can you identify one other proposal that you would have to liberalize or to make tighter the rules here for private placements?
Well, for private placements, I think there's several proposals before us in terms of increasing the caps. If you're talking about me to freewheel and come up with a new idea on rules to make private placements better.
I don't say it has to be your original idea. Pick one idea you like, even if most ideas you steal from somebody else.
I think we all can take a collective pat on the back for what we did in the Jobs Act in 2012. I mean, I think that is directionally what we ought to be doing.
I now want to go to Ms. Thornton. You might have opposed the Jobs Act. I voted for it. I didn't think it was perfect, but I think it's done relatively well. Can you identify a specific one or two ways in which we should tighten it a bit without eliminating its basic concept?
Sure, thank you, Congressman Sherman. I think one of the most important things would be to change the holder of record definition, because in the Jobs Act, it was increased from 500 to 2,000. And when this 12G, Section 12G was enacted in 1964, there wasn't a whole lot of difference between shareholders and holders of record. But over time, because of technology and so forth, holder of record can now mean one holder of record could be an intermediary that holds tens of thousands of shares from thousands of investors. And
Now,
that's
it's one thing if you have an investment fund. I mean, Berkshire Hathaway might own a piece of a company, and we'd count that, I would think, as one shareholder of record, because they're really making the decisions, even though I might own a share of Berkshire Hathaway stock. But in a circumstance where, I've got an account at Merrill Lynch, so do 100 other people, they all have invested, we're all making our own individual decisions. And you're saying that if 100 Merrill Lynch customers are all in a stock, that it could be identified as one holder of record?
I believe that's right. And the thing about this threshold is that once you go above 2,000 holders of record, the company has to make significant public disclosures. And that's as it should be, because they're obviously a big company. This is the way that Facebook remained private.
And we might just set dollar amounts. Say, we don't care if you only have 50 owners. If you're worth $500 billion, you can afford it. We want the information. Your shareholders might benefit from it. And also, we are trying, in some cases, to push public companies in the right direction. I know what's controversial is ESG. What's probably less controversial is an idea I proposed on the floor yesterday, and that is for companies to disclose and analyze how they'd be affected if we had a breakdown of our relationship with China. Because there are a lot of companies out there, what should I say, pre-balloon in their thinking. So there is a benefit to companies going public when they're big enough to deal with the costs, and I yield back.
The chair now recognizes the gentleman from Arkansas, Mr. Hill, who is also the chair of the Subcommittee on Digital Assets and the vice chair of the full Financial Services Committee. Mr. Hill, you're recognized for 5 minutes.
Thank you, Madam Chair, and thank you again for continuing this theme of how we enhance capital formation for businesses of all size. And I thought this was such an interesting group of legislative proposals and such an informed, excellent panel. Thank you all for being here. Before I was in Congress, I spent a lot of time doing Reg D investments, and so I thought many of these reflected some of the things that we've seen over the last decade after the Jobs Act of what we could tweak and fine-tune even better. And on the subject of going public, look, it's just gotten so expensive to be a public company, and the liability is so high that sure, the market cap has just gone up and up and up. When I first started my career, if somebody had a $250 million market cap, they could easily be public and bear the costs, and we had more than double the public companies that we have now in those days. So that's why you see so many enormous market caps, and I think that's why you see a big incentive for so many growth companies to stay private longer. So I don't know if it's a chicken and egg thing. I take Mrs. Thornton's point. Well, I started my career in 1979, so I remember the 1982 amendments, and I know where she's coming from, but I don't think that's a chicken and egg thing. I think really it's the cost that has driven market caps up and number of public offerings down, personally. Entrepreneurs and small business folks are the backbone of all of our small towns, and I'm so glad we have Missouri so well represented here. I represent Little Rock, Arkansas, and so I work with our venture ecosystem throughout central Arkansas. And it's frustrating when you recognize that the top 20 metros in the country get 88% of the venture capital funding in the country. But due to the Kauffman Foundation in Missouri and Steve Case's evangelism, this idea of making sure that we have a venture ecosystem open to all investors of all types has really seen a renaissance in the last decade. The best ideas in this country are not reserved to the salons of Palo Alto or New York. Last year, Arkansas companies raised $107 million in venture capital funding, 3 times higher than 2020. And while that's dwarfed by many states, it's an indicative of the fact that our angel investor groups and our venture ecosystem is growing and growing successfully around the University of Arkansas at Fayetteville and certainly in Little Rock, in and around the Venture Center and accelerator programs that we have in Conway, Little Rock, and North Little Rock. Unfortunately, entrepreneurs in many parts of the country face challenges to raising the capital they need. We just had a bill on the House floor last week that we all supported, which enhanced the SEC studying what are the barriers to rural capital raising for people who are not even in a metro area. And I think your comments on that have been very, very helpful. So Mrs. Howell, with your 2 decades of experience, both in the brokerage business and now as an angel investor, how do these ideas today directly help a startup dreamer in Kansas City or Little Rock?
Our networks are only so large to be able to raise capital from our own personal network. And one of if you're speaking to the fund of funds bill as one example, I can give you an example, and bringing Steve Case back up. 6 years ago, Steve Case and his whole Rise of the Rest, Come Out to the Midwest, invited 20 of us who were brand new fund managers to DC to learn from one another and support one another. And he asked us, how can we help you? And every one of us, by the way, nobody had ever raised more than $30 million. That was our ceiling in our markets. And all of us said, Steve, if you would just invest in our funds, you'd give the good housekeeping seal of approval, and then other people would understand and they believe it. And then we get people who've never done this before, who are accredited investors, of course, off the sidelines. So this idea of the fund of funds would be really dreamy for all of us, because there will be investors that are in other parts of the country who'd probably love to invest in Work Torch.
Thank you.
But they can't find them. And so the way they could find them is through funds like us, who are boots on the ground, finding and helping entrepreneurs.
Glad to see a Morgan State Bear here. That's good. I co-chair the HBCU caucus here in the House, so it's good to see Morgan State represented. Crowdfunding, these ideas to expand crowdfunding. Any thoughts on how you think that would benefit entrepreneurs in your world?
There are a lot of entrepreneurs who don't have networks, especially entrepreneurs who look like me. When I started my first company in 2010, I didn't know what an investor was. right? I didn't know where to go. I didn't know where to meet them. And when I did, I didn't know how to talk to them. But that has no bearing on the entrepreneur's ability to execute. And so an entrepreneur can go to crowdfunding and say, hey, I've executed, I've done well. Who would like to take part of what I'm building?
Great response. Thank you so much, and thank all of you for being here today. Yield back.
Chair now recognizes the gentleman from California, Mr. Vargas, for 5 minutes.
Thank you very much, Madam Chair. What are we doing after dinner? We've had 2 meetings so far, one after breakfast, one after lunch. I assume we'll have one more meeting after dinner. It's been, again. I'll buy. All right. Great. And I hate to challenge my good friend, Mr. Sherman, but Mr. Sherman used a term that he didn't define, and I think it'd be very hard to define at the moment, and that is pre-balloon. We don't know exactly how long the balloons have been flying over our country, so we don't know exactly when the pre-balloon era started. The gentleman will yield, I'll point out we are now post-balloon. We're post-balloon now. Okay, well, that makes more sense to me. Again, this has been very exciting, actually, to listen to all of you, and I appreciate it very, very much. I do have some questions, obviously. Ms. Thornton, you said we should rebalance the public-private market, I believe. And how should we do that?
Well, one way is the way that I mentioned to Congressman Sherman about modifying Section 12G to say that holder of record is actual shareholders, beneficial owners of securities. Another, of course, would be what he alluded to, which is to say that large companies that are have a certain value are subject to the public disclosure framework. Or you could say that companies that have a certain number of employees would need to comply with the public disclosure framework. And aside from that, I think that it's really important for policymakers, for Congress and the SEC to look at the existing exemptions and consider whether they really are doing what we think that they're doing and what we want them to do. When you look at what's going on right now, just because an exemption is expanded, to allow retail investors who are less wealthy to participate and to invest in these funds doesn't guarantee that there will be more investment in businesses run by women and minorities. Doubling down on a system that we've had, like, I think I counted 14 expansions of the different exemptions since 1982, including the 1982 Reg D, and doubling down on a system that's already shown not to promote women and minorities is unlikely to help. So I would encourage you to think about that and to look at the different exemptions and consider how they might be scaled back.
Mr. Elenoff, I think it would be appropriate to give you an opportunity to respond to that. What would you think about those?
I appreciate the opportunity. I have in front of me the annual report from the Office of the Advocate for the Small Business Capital Formation, and they have 2 bubbles in crowdfunding that I think may be instructive and responsive to that comment. 41% of crowdfunded issuers that raised $1 million or more had minority founders. Another thought bubble, 46% of crowdfunded issuers that raised $1 million or more had women founders. And I would encourage everybody on the committee to go and review this annual report, and I think you will see outstanding statistics that support not only that underrepresented people raise money much more effectively pursuant to these Jobs Act exemptions, including Reg A+, 506C, but if you look at the geographic dispersion in their charts, along with what's on Crowdfund Capital Advisor's site, you'll see that almost every state in the union is represented, as opposed to what happens with 506B venture deals.
Thank you. I do want to challenge one premise that I think is underneath all of this, or not challenge it, but ask about it, and that is the issue of returns, so that the private markets have better returns in general than the public markets. Back in 2019, we had Professor Elizabeth de Fontenay testifying that that's not the case, my understanding. Could you comment on that, Ms. Thornton?
Sure, I'd be happy to. When you look at the private markets, private market participants don't have to disclose information. So that should be a red flag right there. Even the financials that they do disclose are not necessarily audited by independent auditors. So, and the information often isn't timely. There's information given to some investors that's not given to others. What does this create? This creates an environment where valuations can be inflated, and there's copious evidence that valuations are inflated in the private markets. What happens is these companies, when they go public, they stay in the private markets for a long time because they can raise a lot of capital now that there are all these exemptions. But when it comes time to cash out, when the original investors want to cash out, they do an IPO and retail investors invest, and they're the ones who lose out because the company was overvalued. There's evidence, I think Goldman Sachs did a study that showed that something like 28% of the companies that went through IPOs like this declined in value tremendously.
My time is up. Thank you very much. Thank you.
Chair now recognizes the gentleman from West Virginia, Mr. Mooney, for 5 minutes.
Thank you, Mr. Chairman. So nearly 20% of the U.S. population lives in rural areas, and yet businesses in rural areas raised under 2% of the total capital over the last 3 years. In my home state of West Virginia, no city even has a population greater than 50,000 people in the entire state. So, Ms. Howe, can you elaborate on some of the capital raising trends for small businesses in rural areas versus those in big cities? And a follow-up to that, why is there such a large discrepancy in the trends?
I'm sorry, can you repeat
The second part of that is, why is there such a large discrepancy in the trends?
First, my brother played basketball for West Virginia.
All right.
I'm not sure I completely understand the question about the trends, but the trends clearly in our market and what I see in my other fellow small fund, folks who are building small funds in other states, because we're a co-investment model, so we have to have another venture investor in our round in order to invest. And what I've seen is it's broadened out who people like me, I'm 66 years old, female, are starting funds. They're not all young white males. So we all have different experiences, and I think these smaller funds are being started by people who then are broader in thinking and how they look at the kinds of deal flow they might look at. There's one proposal I have seen regarding angels and demo days, and I'd like to address that in some of the smaller areas. The reason why Silicon Valley became Silicon Valley is because of the network effect. They knew each other. They were in a small community. It was like a small town that the investors and the entrepreneurs got together and helped one another, funded one another. And we need that in our smaller towns. And demo days are a very important way for angel investors, curiosity seekers, people who want to help these entrepreneurs, again, who are their neighbors or their kids, their friends' kids or whomever, to help them. And so I think the basket of proposals that I see here help each in a little different way. I don't think you could prioritize them, because I think a place like West Virginia, where you have demo days, a demo day in small town where you have 2 or 3 entrepreneurs who are starting something, who just want to get a forum and get their idea out there and see if there's somebody who could help them, is critical to them getting funded and finding resources and advisors and people who will help them. Does that answer your question?
Yes, thank you very much. I'm just trying to get an idea of what you think the trends are and what's happening. My next question is for Ms. Gladney. What are some of the unique challenges rural small businesses face, and what can be done to address them?
Well, thank you for the question, Congressman. The biggest thing that I have experienced and I've witnessed is that this is a relationship-based industry. And so if you're living in an area that does not have an established ecosystem or established network, then you have no network. And so, unfortunately, the way that the system is currently set up right now, it doesn't bring people in, it keeps people out. And so that's what's happening to rural entrepreneurs. If you're not connected to the ecosystem, if you don't have that within your community, then it's extremely difficult for you to infiltrate the system.
Thank you. I mean, I assure you rural poverty is real. It's not just in the big cities. Internet connectivity is an issue, especially the high-speed internet. The basis of population where you can crowdfund may be harder to find. So last week, the House, thank you for the bipartisan support. The House passed my bill called Expanding Access to Capital for Rural Job Creators Act. simply requires a Securities and Exchange Commission, a Small Business Advocate Office to identify and report the challenges that rural small businesses face when trying to access our capital markets. That's only one step. We must do more. So I look forward to working with this committee to make sure rural small businesses aren't left behind like we face these challenges in West Virginia. So thank you, Mr. Chairman. I yield back.
May I add to that about SSBCI? Thank you so much for SSBCI, because SSBCI coming down to the states, the state of Kansas, as an example, is using that. There's a lot of rural Kansas, right? They have 105 counties of rural everything, and they're using the SSBCI money to do all the things to find and support entrepreneurs in each county. So thank you all very much for that money.
Gentleman's yielded back. I now recognize the gentleman from Illinois, Mr. Caston, for 5 minutes.
Thank you, Madam Chair, and thanks to all our witnesses. Ms. Howe, I've been sitting here reading your resume and thinking that in another life you and I might have run across each other. Before coming to Congress, I raised a lot of capital in for privately held companies. When you were, just want to understand a little bit about your background at Merrill Lynch's private banking practice. Was that primarily for, I assume that's like wealthy families and family offices who were your clients? Is that right?
Yes, my investors were families of wealth.
Oh, okay. And was there like a minimum size that you were targeting or a typical size? Like just help us understand who your clients were typically.
Back then, my minimum size was $10 million and up.
Okay. And were they investing primarily equity, or were you advising them across the whole capital structure, debt and mezz instruments and everything else?
The entire capital structure, including their philanthropy and multi-generationally.
Okay. And if they were investing in debt or mezz, were you guys like actually negotiating debt deals, or was this, where you'd be negotiating covenants, or were you primarily backing into other like previously syndicated deals?
No, Merrill Lynch was pretty much a distribution of other people's investment ideas. So,
Okay.
yeah.
And did you make many direct investments outside of the public? I mean, were you doing real estate? Would you ever advise them to make a direct investment in a new business like we're talking about here today?
Made none on behalf of our clients, but I made personal angel investments.
Okay. And I'm thinking this from the perspective of a family that's got minimum 10 million wealth. I'm assuming they have some direct investments, whether through funds of funds or, they've got a buddy they went to college with who's, the things you do as a private wealth manager. Would you help with the diligence on those investments for them?
Did I help with diligence?
Yeah, so
Absolutely.
if you've
For
got a
our
wealthy
portfolio-
family saying, I need to do this, but I don't understand the financials, and, should I trust this auditor, those sorts of things that one gets into where they need a neutral party.
Happily, it gave me a lot of 32 years of education to read financial statements because I'm now on 11 boards of our portfolio companies. So, yes.
Well, as I sometimes say that the best preparation I ever made for running for Congress was running a private equity-backed company, because I learned to live with the fact that I was going to be surrounded by really smart 20-somethings telling me how to do my job. It's the nature of this line of work. So I ask all those questions because I don't know how somebody who has $10 million in personal wealth makes an informed judgment about how to invest in a privately held company without having someone of your talents. It's just too complicated, right? And yet now we're having this conversation saying, should we make it easier for people who can't afford to hire someone like you, right, to run through those investments? And so my question for Ms. Thornton is, as we talk about expanding access in private markets to people who can't afford to hire Ms. Howe, who are not worth $10 million, who don't pass anybody's existing definition of a sophisticated investor, number one, is it not our obligation as Congress to provide them with the protections that they would otherwise get from someone like Ms. Howe?
Absolutely. In fact, I would submit that probably they shouldn't be going into the private markets, but if one is going to expand exemptions, it's really critical that the information be provided. And the bigger the exemption, the more information should be provided. There's a reason why we have the public markets and why we have the disclosure. In the private markets, sorry, did I say private? I meant to say the reason why we have public markets is for disclosure. But what happens in the private markets is that there's no information values are inflated. The original people, Ms. Howe's clients who originally came in and put money into that investment, whatever it is, they can actually cash out because we're also seeing an expansion of secondary markets in the private markets. They can cash out, and all those new retail investors who came in who really couldn't afford to lose their money and you know, have bills to pay and can't afford a catastrophic loss, they're the ones who lose out. They don't get the benefit of the high valuation.
So just with the 25 seconds I've left, there's a whole number of bills that have been noticed and you've reviewed for this hearing. All would seem to make it easier for companies to access money from smaller investors. Are there any of those bills, in your judgment, that provide greater protection along the lines that Ms. Howe used to provide?
I skimmed through them. I didn't have a lot of time between when I saw them and this hearing to go into detail. I guess I would just say that, you know, basically, the committee should look very carefully at what they're going to accomplish actually for small businesses.
Thank you. I yield back.
Chair recognizes the gentleman from Oklahoma, Mr. Lucas, for 5 minutes.
Thank you, Chair, for holding this hearing, and to the witnesses for testifying. Businesses use both private and public markets to raise capital, and the committee's dedicated to ensuring both avenues are healthy for both companies and investors. Public markets have enormous benefits to a wide range of investors, and we'll continue to support policies that strengthen public markets and encourage businesses to utilize public offerings. We also recognize that healthy private markets supports our robust public markets and benefits both companies and investors. That said, Mr. Elenoff, could you discuss the advantages to companies and investors of having access to both public and private markets?
The democratization of access to deal flow, which is what the Jobs Act really did, established a mechanism by which investors from around the country could invest in deals in other parts of the country that they would never otherwise have had the social networks to know that those deals were looking for money. And they post those deals on websites called funding portals that are staffed by investment professionals that do extensive due diligence on the deals and respond to some of the concerns that were raised previously. And so those deals are vetted so the investors can have access and invest in those deals. And have access to early valuations like is being suggested is a problem that if you don't get in on the earlier deals while they're private, you won't benefit from the increased valuations over time. I think retail investors having access to both the public markets, which they do through their Merrill Lynch or E-Trade account, where they don't have other people doing diligence for them necessarily, is equally important to learning how to invest. What's great about the crowdfunding provisions generally are there are caps in Reg CF that limit the amount of exposure that retail investors have. And as far as I know, after a decade, neither regulators nor commercial participants have been upset by the results over the last decade, which is a reason why we can continue to liberalize.
Continuing along that line, Mr. Elenoff, we are 10 years from the passage of the Jobs Act. Could you give us your perspective on what we're seeing in the economy that should encourage Congress to revisit provisions of the Jobs Act?
Well, I'll give you a statistic. I spoke to Sherwood Neese, who was the godfather of crowdfunding, if you remember him traipsing through these halls in 2012. When we increased Reg CF from 1 million to 5 million, which we had wanted from the beginning, 5 million, 435 companies in the last few years have now raised more than the $1 million cap, which increases jobs, funding for entrepreneurs, helps individual states across the country, and again, minorities and women. 45 of those companies raised the $5 million max. So why would we not increase it further in order to get more company to raise more money to carry out the empowerment of the American dream for entrepreneurs?
Thank you. Very insightful comments. May I yield back, Madam Chair?
Gentleman yields back. The chair now recognizes the gentlewoman from California, Mrs. Waters, the ranking member of the Financial Services Committee, for 5 minutes.
Thank you very much. I'd like to address Ms. Thornton. Ms. Thornton, when most Americans think about our capital markets, they think of the New York Stock Exchange and stocks sold by large companies like Apple, Ford, or GE. However, many would be surprised to learn that the private markets now dwarf the public markets. And as I understand it historically, the private markets were where small businesses raise capital. But today, even the largest companies now raise much of their capital there. Can you provide a little more context as to how these changes have affected small businesses trying to raise capital and the impact on public markets? What do you think Congress should do or should encourage the SEC to do to support small businesses through capital markets?
Thank you, Ranking Member Waters. I appreciate the question. I think that historically, for like 5 decades after the securities laws were enacted, after the stock market crash of '29, we had a situation where the courts interpreted public as very broad, and so even sometimes situations where there was, one shareholder or a few, those companies were required to make public disclosures. Then with all of these proliferation of exemptions, the private markets grew, and as you said, today the private markets raise more annually than the public markets do. And the problem with that is that it's now there's no incentive for a company to go public, and that has serious ramifications for not just the people who invest in a company that's private, a company that doesn't disclose financials that are independently audited and so forth, but it also has ramifications when that company gets large and it sells products to American consumers. And if it runs into financial difficulties because it hasn't been overseen by regulators, that can actually have systemic problems in the capital markets. And that's what the SEC, that's another big part of the SEC's mission. So in addition to ensuring that investors and companies have adequate information when they invest in those companies, the SEC also needs to be aware of potential for systemic problems. And so we need to consider whether this situation we've gotten ourselves into needs to be rolled back a little bit. And I think it makes a lot of sense to look at these exemptions and consider how they can be trimmed back, whether we really need or want big companies in the private markets, and whether we shouldn't have a lot more disclosure for much of what goes on in the private markets.
Let me continue. Today, large private equity firms and multi-billion-dollar tech companies have taken advantage of exemptions originally meant for small businesses. For example, between 2009 and 2017, pooled investment funds, most of which are private equity funds, have raised $8.9 trillion of new capital through Regulation D, offerings compared to $1.42 trillion raised by non-funds. What are your views on the uses and misuses of the exemptions originally meant for small businesses? Should multi-billion-dollar private firms and private equity firms be able to use them?
Absolutely not. I mean, it's basically an abuse of the system, if you will. I mean, when these really large, when these unicorns who have so much in assets and so much ability to raise capital are using something like Reg D to raise funds. And I think Commissioner Crenshaw just a week ago mentioned this as well, how much of Reg D is actually unicorns seeking additional capital. It just creates risks for, as I said, for the markets and also for the many people who invest.
Thank you. I'm going to go to Chair Wagner before I, continue with these questions. I would like to ask unanimous consent to submit a report for the hearing record that was released by North American Securities Administrators Association entitled Report and Recommendations for Reinvigorating Our Capital Markets.
Without objection.
So I have a few minutes left here, and I'll just have a statement I'd like to make. Constantly all that we hear from small businesses is, I just don't have access to capital. If only there was a fair way to get access to capital, I know I could do well, I could expand, I could provide more goods, more services, I could do all of these things. And so as we confront this issue, we've got to find out what we can do. Quickly, under the pandemic with PPP, in that small period of time where we raised that money to get to small businesses, I want to tell you how helpful it was, how thankful they were, and how they were able to keep their employees, on and on and on. With that, I yield back, because I could talk about that all day. Thank you.
Gentlelady yields back. I now recognize the gentleman from Pennsylvania, Mr. Muser, for 5 minutes.
Well, thank you very much, Madam Chair. Madam Chair, first, I'd like to request unanimous consent to enter into the record several letters. First, a letter from the U.S. Chamber of Commerce and a letter from the Center for American Entrepreneurship.
Without objection.
Thank you. And thank you very much to our witnesses. It's quite informative. I appreciate it. But I also appreciate our chairwoman and of the subcommittee, as well as our chair of our full committee, Mr. McHenry, for this focus on and prioritizing of capital formation, especially for small businesses, and really working to build off of the Jobs Act. I spent most of my life in small business, growing small business into a large business, and working with customers that were all small businesses, or virtually all of them. And I also sit on the Small Business Committee. So these topics are extremely important to me. Access to capital, cash flow is the lifeblood of a business, as we all know. Yet, all data continues to show, even this morning in a hearing, that only 13% of households, of those who want to invest, have the ability to be an accredited investor. And as well, only 19% of small businesses would state that they have adequate access to capital. So we clearly have work to do. And as well, last year, there was an enormous decline in IPOs, as you know. The numbers I have show that 74 IPOs. Now, granted, the year before was quite high, but that's 3 times less than the typical average over the last 10 years. So, so what's going on? We need to remove these barriers, or we can begin to count start thinking about how many new growth businesses, technology businesses, what have you, that will not be created here and could be created elsewhere. So a couple of things. Ms. Howe, I'd like to just ask you first. The DEAL Act that was introduced last year, Developing and Empowering Our Aspiring Leaders Act of 2023, decentralizing investments. Is this something that you think is very important, the DEAL Act? So?
I'm sorry, that's the Fund to Fund Act, right? So
It is.
getting all of these confused.
Yeah.
I think I addressed that a little bit earlier. The funds, we are the most entrepreneurial country on the planet. How do we figure out how to continue to keep in our genius zone, and that is by broadening the access. Broadening access in our world, in Kansas City, and Kansas and Missouri, is to have other people know what kind of great entrepreneurs we have here. And so having fund to funds have the ability to find, they won't invest directly into WorkTorch, but they would invest in our fund. And our little fund could use the extra capital. We've turned away hundreds of other investors. You're right, Congressman Sherman, there are a lot of deals that shouldn't get funded. And, but there are a lot that don't get funded, right, because we don't have the capital, and we build syndicates of folks from outside our region. And the best way for us to build syndicates, one is what we do now is mano a mano. We just go out and we find other VC firms that might be interested, and we go out and sell the deal to other folks. But in this case, for fund of funds, it would be so much easier for people to develop a fund, sure, because you get the good housekeeping seal of approval of a Steve Case or whomever else that would say, yes, this is a venture firm, talk about its relationship built. This is a venture firm that has a good track record, they know what they're doing, we would
Good,
invest.
thank you. So you're positive about that. And the I CAN Act, Improving Capital Allocation for Newcomers Act of 2023, expanding the eligibility for capital contributors?
We are on our third fund. We've raised 27 million of the 40 million that we'd like to raise, and we're already up to 70 investors. And we have a list of folks who would love to get in for $50,000, but I don't know that we can take them because we don't have room for them under 99, under the 99. So if
for it then. It's
we
something we
had
should-
more room for investors, we could take much smaller investors. And in a fund format, by the way, that is de-risking the riskier part of the capital stack. So I believe strongly in smaller investors should be in funds.
Yeah, there's no question. You know, VCs, there's a saying, it's easy to count the seeds in an apple, but not so easy to count the apples in a seed. So I definitely commend the work that you all are doing. And we're very interested in hearing more from you. I'm just about out of time, from all of you on what else this committee needs to do. So I appreciate your time, and I yield back, Madam Chair.
Gentleman yields back. Chair now recognizes the gentleman from North Carolina, Mr. Nickel, for 5 minutes.
Thank you, Madam Chair, and thank you so much to the witnesses for being with us here today. Small businesses are the backbone of our economy and of my district. In Congress, I'm doing everything I can to ensure that they have adequate access to capital. Additionally, retail investors need the protections of our securities law to ensure they have access to vital financial information. If a company is underperforming, these non-professional investors would likely have a hard time accessing this information. Ms. Thornton, how would removing disclosure requirements harm retail investors that our small businesses, especially our minority-owned small businesses, rely on for capital?
I think it's important to remember that if you're a small business, you're actually going to prefer having just a handful of really sophisticated, really experienced investors that you can go to when you need more capital. Having a lot more investors, retail investors, people that don't really know as much and really can't afford to lose their funds, can actually be harder for the small business if they have to respond directly to them. And also, if those retail investors need to pull out of their investment, which typically in the private markets, investments are locked up for some time. So it's very difficult for retail investors in that case, and it's bad for the small business. So I think that the disclosures that we're talking about, making more disclosures, is actually both good for the small business and good for the retail investors. And Mr. Elenoff referred to democratization and how much due diligence is being done and all of that in his firm or the firms he works with. But in reality, that's not required at all. It's not mandated. It's not overseen by the SEC. The SEC doesn't have that information. But also, if companies are doing this due diligence anyway, if funds are, if companies are providing the information to the funds that hold them or whatever, there shouldn't really be any problem with adhering to the public disclosure framework. They should be able to disclose more information.
Thanks. Ms. Thornton, as you said in your testimony, if a company can raise all the capital it needs in the private markets without making disclosures, developing robust operational safeguards, subjecting itself to audits, or subjecting itself to SEC oversight and potential class action plaintiffs, why would it go public? So does the current exemption framework incentivize companies to stay private, therefore depriving investors of information that's important and meant to protect them?
Absolutely. It definitely encourages companies to stay private, to grow in the private markets, and really never to go public unless, for example, the founders or original investors want to cash out. And so basically, we have a perverse, distorted system where capital now is being invested with no information, which is basically the situation we had before the stock market crash of 1929.
Thank you so much, and I yield back.
Gentleman yields back. Chair now recognizes the gentleman from Iowa, Mr. Nunn, for 5 minutes.
Thank you, Madam Chair, and privileged to have another Midwesterner sitting up here. Your appreciation for capital outside the VC bubbles of certain communities is much appreciated, and I think something that we would like to talk about today. You know, as we sit here today, roughly 11 years after a divided Congress passed the Jumpstart Our Business Startups Act, or the Jobs Bill of 2012, we are still faced with similar challenges to help all entrepreneurs, many of you here in this room, as well as our Main Street shops, our small farmers, and the small businesses that grow off of them. And unfortunately, my perspective, time and time again, DC has added costly bureaucratic red tape that interferes with my constituents' abilities to come here and serve well in this. The House is determined to reduce regulatory burdens for small businesses and entrepreneurs at home. In my great state of Iowa, a record number of more than 33,000 new businesses were started in the last year alone, post-COVID. It's our responsibility to provide adequate funding opportunities for those who take this amazing leap of faith, as you have on this panel today. So, Mr. Conwell, I'd like to begin with you. When the Jobs Act was passed, one of the things that critics were most afraid of was the law would dramatically weaken investor protections and increase fraud in the securities market. But 11 years on in the Jobs Act, those predictions have not come to pass. Congress has continued to work on bipartisan issues to build upon the Jobs Act. In your view, how would a small business and entrepreneurs today in a state like mine in Iowa benefit from some of the new bills we are considering today?
Well, one, you're now allowing for angel investors to be more active. And when you're talking about rural parts of the country, or you're talking about states outside of the major tech hubs,
right,
they're all funded and backed and supported by those local individuals. It's so important for the angel investors to have the ability to do more. Then when we talk about the ICANN Act, it allows for more newcomer investors to have more opportunities to raise capital. I wouldn't be able to raise capital if it wasn't for the Jobs Act and the 506C designation. And because of that, I now have investors in my fund from all over the country, and I am investing in companies from all over the country. Every investor is not going to do that, but it gives us the opportunity to have more investors with more ideas and more different ways to go about investing.
I love that innovative spirit. Well done, and compliments on everything you've done there. Ms. Gladney, I'd like to speak with you on this as well. According to the SEC's office, the advocate for small business capital formation, small businesses have accounted for 66% of the employment growth over the past 25 years. However, 89% of entrepreneurs claim that that access to capital is limiting their small business. In fact, 78% claim it's limiting their day-to-day operations, which is very scary for a small entrepreneur. Could you please talk about your experience during the early stages with WorkTorch, and specifically in Kansas? What was one of the most difficult parts for you to be able to start WorkTorch?
Well, Congressman, thanks for your question. And I was born in Ames, Iowa, so fun fact.
There you go, hot cyclone territory.
Yes, you know, I appreciate that question, because I think so much we talk about startups and small businesses when they're past that 0 to 1 phase. That 0 to 1 stage is so difficult. So when my co-founder and my sister, Angela and I, when we decided to start WorkTorch, we had so many barriers when it came just to even knowing or understanding. It was very clear that we were outsiders. We didn't even know there was an ecosystem that existed. So of course we didn't know the players. We didn't understand the language. Right. We didn't understand any of that. So just even trying to get from 0 to 1 was so challenging, which is why we had to do something so risky as taking our 401ks, because we were seen as outsiders. And so really, the more that we can support entrepreneurs in those earlier stages, I think unfortunately, a lot of businesses, they die in that 0 to 1 ideation stage.
I would agree with you on that. So let me be quick in this, because I think this is an important thing for entrepreneurs like you across the country. As you know, Reg A, or the mini IPO offering process, is less intensive and less costly than the traditional initial public offering. Do you think, and based on your experience, it's time for Congress to revise Section A? Specifically, House Republicans are advocating that we raise the amount to $150 million from the current $50 million and include an inflation adjuster. Would this have helped you?
Absolutely. You know,
Yeah.
I think just increasing the access, of course. I mean, there's absolutely, it would help. You know, I see that the time is running out, so I just want to keep it brief.
Thank you for your service. I yield back my time.
Thank you.
Gentleman yields back. I now recognize the gentleman from the Kansas City, Missouri area, the soon-to-be Super Bowl champs, Kansas City Chiefs, my fellow delegation member, Mr. Cleaver, for 5 minutes.
Thank you for that opening objective analysis of the coming game. I was going to ask Ms. Howe before you said anything about the game, and it doesn't mean we're bragging about anything. You know, if you win, you're not bragging. And so we are hoping that the rest of the committee members will come in and celebrate at the next hearing the Kansas City Chiefs as world champions. You know, I'm glad we have some folk who've taken advantage of this. I've been on this committee 18 years, but this is my first time on the capital markets. So, and trying to get up to speed on it, I thought people are going to run away. I mean, a shareholder of record does not denote the current owner of stock. Instead, it suggests who owned it 2 days prior. Now, if you tell somebody's, wanting to participate, go into business, won't they start out getting a headache? I mean, am I interpreting that correctly? Is that correct?
I think there's a misunderstanding here. A shareholder of record for public companies, it is true that often on a central ledger system called CD, multiple shareholders are centralized as one shareholder for purposes of calculating for proxy rules under the public company laws. For private companies, that's not really accurate. It's one-to-one. I think if you ask any of the entrepreneurs or venture people here, you will find that the shareholders that are listed on their record holder are their record holders. And so while I can't say that is true in all cases, I can say it's in the predominance of case. And so the concern that I have when I hear questions like that, if that's the route that the SEC intends to use to force private companies to go public is by playing games with 12G, I think that's problematic.
I appreciate that. Thank you. I'd like to, Ms. Howe and Ms. Gladney, can you speak to the challenges in fundraising for startup companies, particularly those who are pre-revenue, thereby making bank capital largely inaccessible?
Thanks for the question, Congressman. Definitely, the pre-revenue stage was the most challenging stage for us. And again, not being an insider, you go to the websites of a lot of these investment firms that will say, hey, we invest at day zero. So we're like, hey, we're at day zero. And we try pitching and come to find out more than likely they don't. Or it's not for people who look like me or people who don't have that existing connection. And so it's extremely challenging, which is why it tends to put a lot of founders like Angela and I in a corner where it's either we let this idea die or we pull out money that we probably shouldn't pull out to make it work. Once we get the revenue in, at least we can start saying we have traction and it mitigates some of the risk and you'll start to see more people come, but it's still even challenging at that point for founders like myself. I'll let Darcy kind of chime in before time runs out.
Pre-revenue companies are the purview of angels. Angels are more predominant in markets where they've already made money and they're quote on house money. So they can afford to take the risk of giving $20,000 or $30,000 to Angela and Deborah. So I don't think that's the right place for early investors, frankly. That's the place for people who are more sophisticated and who can help these young companies, if that answers the question.
It does. Thank you. Madam Chair, I yield back.
Gentleman yields back. The chair recognizes the gentleman from New York, Mr. Garbarino, the vice chair of the Capital Markets Subcommittee, for 5 minutes.
Thank you, Madam Chair, and thank you very much for hosting this important hearing today. And thank you to our witnesses. Madam Chair, before I have questions, I request unanimous consent to enter into the record several letters. First, a letter from the Small Business Investor Alliance, and second, a letter from the National Venture Capital Association.
Without objection.
Thank you very much. Mr. Elenoff, I want to start discussing Regulation A with you. Title IV of the Jobs Act directed the Securities and Exchange Commission to adopt rules examining securities offering up to $50 million within a 12-month period from Securities Act registration requirements. Upon implementation, the SEC created two different tiers. Regulation A Tier 1 caps at $20 million, and Tier 2 allows for the sale of $50 million, which was later raised to $75 million. The benefit of having Regulation A is that it provides an opportunity for small and medium-sized private companies to access capital on a scale more appropriate for their needs with limited disclosure requirements. Despite these benefits, you mentioned in your written testimony that Regulation A still needs to find its footing. Can you explain why Regulation A has been underutilized, and how would amendments to Regulation A help small businesses raise capital? And would more companies benefit if Regulation A raised its offering cap?
First of all, if we have to recognize the great state of New York together, okay? I mean, if everybody else can do it, we should be doing it, just because we're a big urban center. So Reg A Plus is a more involved disclosure document, not unlike a traditional IPO on an S1. It's on what's called a Form 1A, and it's got extensive legal work, accounting work involved. It takes months to prepare, or weeks in many cases if it's an earlier stage company. The good news, and I spoke to one of the founders of the big platforms this morning, is in the last few years, $5 billion has been raised in Reg A+. So it's an exemption that is getting traction. It's just not as much as I think regulators would like it to be. And many of the major investment banks, since it's a mini IPO, don't tend to follow in that direction. I think increasing it to 150, which is the proposal from 75, would be advantageous in that it may attract a higher quality number of Silicon Valley-based companies that may choose to use it. The costs of doing a Reg A Plus deal and the time and the sophistication kind of necessitate larger deal sizes in order to pay for the diligence that's being questioned here about whether or not these deals are providing enough disclosure so that investors can make an informed decision. When you are targeting retail investors, which Reg A Plus does, you need more involved disclosure. What's not been discussed today, and the reason large companies shouldn't be required to put disclosure, and it's been conventional wisdom in the capital markets for 70, 80, 90 years, is that you have the largest institutions who do the due diligence with people like Ms. Howe at their side, so you don't need that level of disclosure or diligence because somebody is doing it. And so Reg A Plus, there's only been a few hundred deals that have been done on Reg A Plus, and its average raise size is $2.2 million, but we do need to utilize it more and find a utility for it.
And you think one of the things would be raising the cap could get more companies involved?
I spoke to several of the platform managers, and they agreed that there are times when they speak to some of the companies who feel that the $75 million as a top limit makes it unattractive to them, so they won't do a deal on Reg A Plus.
Would I have some more questions, but they're much more detailed than I'll.
One last thing, if I may. It's not been discussed. I'm not really supposed to go here, but I think that if crypto was to become a regulated vehicle, as it's been suggested by our regulator community, Reg A Plus is the perfect on-ramp for it. So far, the regulators have not been accommodated for that conversation, but had they, then $75 million would definitely be utilized on a regular basis.
Thank you. And I do have other questions about this, but I'll have to send them to you. I do want to ask you also about finders. Right now, there's no suitable framework for finders, and because of this, they are treated as broker-dealers by the SEC. Is this a problematic framework for those seeking to make connections between investors and private companies? If so, can you expand upon that? And would changing this and creating a framework benefit rural and underserved areas?
Yes, yes, and yes, and it's been sitting out there for 25 years, and it's just getting fumbled all the time, and there's no good reason not to have finders be able to qualify under the old Paul Anka sort of test or some expanded no action letter like that.
So this is really affecting access to capital. We need to fix it.
Without question, small businesses need people to help them identify appropriate investors.
Thank you very much. I yield back, Madam Chair.
Gentleman yields back. I think we have completed our questioning time period. I'd like to thank all of our witnesses for their testimony today. So much of it was just absolutely inspiring. And I thank each and every one of you, as does our committee. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for their response. I ask our witnesses to please respond as promptly as you are able. The hearing is now adjourned.